Yes, people, good morning, good afternoon, good evening to all South India student. How are you? Hope so you are good. I am also good. So guys, today we are going to discuss about some new case laws applicable for your examination, that is May 2024. And along with that, we will discuss certain circular notification also. And after that, guys, there is a one topic in your international taxation, one very small topic, that is the latest development of the international taxation. This topic we will discuss in today's session. Okay, so let's start with the case laws. So there are total 5 case laws, and all 5 case laws are from the Supreme Court. So whenever there is a Supreme Court judgment, then guys, I can say that it is more important for your examination, and there is high chances that this case laws will cover in your examination. And guys, out of 5, I feel that at least one, and it can be two also, 2 case laws will be in your examination. Okay, so let's start with the one by one. First case law is a Mahale Anand Filter System Private Limited 2023 judgment and Supreme Court case. Now guys, what happened here, guys? This assessee, this is our assessee. Now our assessee took one premises on the rent. So can I say that when our assessee took the premises on the rent, so that owner is a different person and our assessee is basically tenant, or I can say that our assessee is a lessee and that other person is a lessor. Now if you know that, if you remember, then you know that always whenever if you take any property on the rental basis, on the lease, then obviously lessee has to give some security deposit. Lessee has to give some security deposit to the lessor. So what happened here? Our assessee has paid security deposit of the 5.8 crore to the owner. So lessee paid the 5.8 crore a security deposit to the owner. That owner is a lessor. Now guys, what happened? There was some dispute between the owner and tenant, or dispute between the lessor and lessee. And to settle that dispute, here our assessee, this company has just waive off that 5.8 crore deposit because they have paid that deposit. And guys, they paid that deposit, and to just settle one of the dispute, they foregone that security deposit. Now question is that this 5.8 crore security deposit they have foregone, it will be treated as a revenue expenditure or capital expenditure. Means is it will be treated as a revenue expenditure or capital expenditure? That is the question. Now assessee claimed that it is a revenue expenditure, so it is allowed under the head PGBP. In the P&L debit side they can claim the expenditure, but department says that no, it is a capital expenditure. So guys, Supreme Court decided this case law. Supreme Court just checked that basically when you give any deposit, so question is that what is the nature of deposit? Is deposit nature is a revenue or capital? Right answer is it is capital expenditure, and when it is capital expenditure, then obviously it is not allowed as deduction. It is not treated as revenue expenditure. So just pay attention. Here question was, can foregoing a security deposit to settle a dispute be considered as revenue expenditure? When assessee sought to vacate certain lease premises, dispute arose, and to end the dispute with the lessor, the assessee agreed not to claim the security deposit of rupees 5.8 crore. The Supreme Court, that is Apex Court, affirmed the decision of the High Court, which held that the amount of 5.8 crore could not be treated as revenue expenditure merely because it was paid in the course of dispute. It is evident that the character of the amount was of capital nature and remains so, although the assessee decided to forego 5.8 crore as a security deposit. So suppose that security deposit is foregone by the lessee, it will be treated as a capital expenditure. It is not treated as revenue expenditure. Now guys, second case law, and this case law is also interesting. One case law of the KBD Sugars and Distilleries Limited 2023 Supreme Court judgment. Now guys, if you remember, we have discussed one concept called demerger. Now what happens, suppose this assessee is having one assessee is having 2 unit, and guys, 1 unit they have demerged. Now guys, in case of the demerger, like that old company is known as the demerged company, and whatever new company, that is known as the resulting company. That new company known as the resulting company. Now new company known as the resulting company, that existing company is known as the demerged company. Now guys, in India, demerger means if 5 conditions are satisfied. First condition is Okay, like all asset and liabilities of this segment should be transferred to the resulting company. Means all asset and liabilities of the this particular undertaking, or I can segment, should be transferred to the resulting company. Second condition, it should be transferred on the book value. Now, third condition is like 75% value of shareholder of demerged company should become the shareholder of the resulting company. Now, one more condition was, if you remember, then there was one more condition, like whatever the whoever the shareholder of demerged company, they should get the proportionate share of the resulting company. And one more condition, that demerger should be on the going concern basis. Now, question is that what do you mean by the going concern? Now, what happened in this particular case law? One company was having the two undertaking, but guys, suppose this undertaking was not functional. Means at that time, suppose that undertaking was not functional, and guys, non-functional undertaking, they have transferred to this company, and after some time they started business again in that resulting company. So question is that when non-functional undertaking is transferred, then it will be treated as going concern or not? Means going concern means going concern means a running unit should be transferred, or even if it is not a running unit, then also it's okay, it will be treated as the demerger. So that was the question. Now, if you remember the Reliance, you know that Reliance also did the demerger, and in the Reliance there was one undertaking in the name of the Jio Financial Service. Jio Financial Service was not doing business as of now. Now they will start their business and all. So Jio Financial Service, they have like demerged, and after that Jio Financial Service Limited is a resulting company. So question is that here the question is that, okay sir, what do you mean by the going concern? Going concern means, is that undertaking transferred to the resulting company, is that undertaking should be a running undertaking? Or if that is not a running, then also it's okay. Right answer is, if it is not a running, then also it's okay. Guys, going concern means it is if all the asset and liabilities transfer, as well as all the like asset, including intangible asset and all transfer, then all employees transfer, that is known as the going concern. Going concern does not mean that that undertaking should be a running undertaking only. You got my point or not? Yes. So try to understand this case law, what happened in this case law. So can a resulting entity, because question was that, like, you know that if you remember in the setup and carry forward, we have discussed one point, whatever the loss of that undertaking, that can be set up and carry forward by the resulting company. Business losses can be set up and carry forward other than speculative business, and unabsorbed depreciation also can be set up and carry forward. So guys, whatever the loss of this particular segment, that loss can be carry forward and set off by this resulting company. But it can be set up and carry forward only if it satisfied that 5 condition of the demerger. So that was the question. Can it be set up and carry forward the losses and unabsorbed depreciation or not? So here, all people pay attention. What happened in this case law? So can a resulting entity set up and carry forward losses of the dysfunction unit of demerged entity? I take opinion that word used in the going concern basis under section 2 clause number 19AA subclause number 6 only means that the transfer should be based on the going concern. It does not mean that the undertaking being transferred should be a going concern as on the date of the transfer. Scheme of demerger which is approved by the court. Guys, always scheme of demerger is approved by the court. Court approved the scheme of demerger, as well as amalgamation scheme is also approved by the courts. Clearly established that the fact that the transfer of undertaking is indeed on the going concern basis. The asset, liabilities, employee, debt, obligation, right, etc. of the undertaking immediately prior to the demerger stand entirely vested with the assessee upon the demerger. So here going concern means, guys, all the asset, liabilities, employee, debt, obligation, right is transferred to the resulting company. It will be treated as a going concern. This amount to transfer of undertaking on the going concern basis. A simple reading of same makes it very clear that assessee is eligible for the benefit under section 72A subsection 4. The act does not state that undertaking being demerged or to be going concern at the time of demerger. So basically act is not saying that at the time of demerger that unit or undertaking should be a running undertaking. Okay, it should be transferred on going concern basis. That is the one condition. Now it only states that undertaking being demerged should stand transfer in the manner similar to the manner in which going concern is transferred. Accordingly, the High Court held that if a unit were running and profitable, the same would not be available for the demerger. Here, High Court says that suppose if any undertaking which was a profit-making undertaking or running undertaking, so there may like mostly they will not demerge that undertaking. They will not demerge that undertaking if that undertaking is a profit-making, profitable or running undertaking. It would be incongruous to constitute section 2 clause number 19 AA to means a running unit. So we will not consider as a running unit, means it should not be a running unit. The scheme of demerger has been approved by the High Court and therefore the assessee was entitled to set off the brought forward losses under section 72A subsection 4. The Supreme Court affirmed the decision of the High Court. Now next part is the next case law is from the Sikandrabad Club 2023 Supreme Court judgment. Now guys, what happened? You know that there is a one concept is called mutuality. Mutuality in India, all the clubs means that sports clubs and all, not that disco club and all. Club means that sports club and all, as well as any NGO and all, that is called like a club. So guys, in case of the club as well as in India, all the housing cooperative society, they always work on one principle that is called mutuality. Now mutuality principle says that you cannot do the business with yourself. Means to do the business or to earn the income, there should be a separate person. But in the mutuality concept, what happened? Like for an example, I can take one example. Suppose we all decided that on 31st December, we will do the party. So let's contribute 1,000 rupees. So we total are 10 people. We contributed 1,000. So total contribution is 10,000. Now out of 10,000, suppose 7,000 we have spent on that party. So our remaining amount is 3,000. So question is that is 3,000 is our profit? Answer is no, that 3,000 is not your profit due to the mutuality concept. Because we cannot do business with ourselves now. So due to the mutuality concept, this 3,000 is not treated as profit. So guys, all the club in India are working on the principle of the mutuality, means they collect the contribution from the member and they spend that money for the benefit of that member only. So whatever remaining amount, whatever surplus or excess, that is not treated as income. Now what happened in this particular case law, one of the club, now in club, one bank is a member. In one of the club, bank is a member. And guys, suppose that club gives some money to the bank and like as a deposit, as a fixed deposit, and that fixed deposit made with the bank and bank is paying the interest. Now question is that interest will be exempt on the principle of mutuality or not? Right answer is how it will be exempt. Like mutuality concept says that suppose member contributed something and it is spent for the benefit of member, then obviously whatever the remaining amount, that is the exempted. But guys, here what happened, one club open one fixed deposit account with the bank and bank is a member of that club. Now question is that whatever FD interest they have received, is that FD interest is exempt on the principle of mutuality or not? Right answer is no guys, it is not exempt on the principle of the mutuality. You got my point or not? Yes guys, here try to understand. That is the Sikandrabad Club 2023 Supreme Court. Does the principle of mutuality apply to the interest income derived from the fixed deposit made with the bank by the club if such banks are member of the club? Now the deposit of the surplus fund earned by the club in the bank which are member of the club, the principle of mutuality applied till the stage of the deposit of fund and would lose its application once the fund are deposited as a fixed deposit in the bank. So when like club deposited that amount with the bank in the fixed deposit, means they lose that principle of the mutuality. And guys, bank will use that money for their commercial purpose. They will give as a loan to someone and all. So they will use that money for the commercial purpose and all. This is because the fund would be exposed to the commercial banking operation, which means that the deposit could be used for lending to the third party and earning a higher interest thereon by paying a lower interest rate on the fixed deposit to the club. Now, the bank utilized the fund of the club deposited in FD receipt for their banking business would completely rupture the privacy of the mutuality. So here guys, here what they are saying that when banking, like bank use that money for the banking business, they are let out that money or lending that money to someone, they are doing their business and they are using that money for that purpose. So it's completely rupture. So here they completely rupture means basically they, you can say that this is like disregarded, you can say that principle of mutuality. And as a result of the element of completely identity as a result, the element of complete identity between the contributor and participator would be lost. Conversely, when a club provides its facility to member who contribute to its income, the principle of mutuality apply due to the identity between the contributor and participant. However, where the same facility are offered to the non-member or to the public to generate the additional income, it transform into the commercial transaction and the principle of mutuality no longer apply. Accordingly, Supreme Court held that the interest income earned on FD made with the bank by the club has to be treated like any other income from other sources within the meaning of Section 2 Clause 24, and it would be liable to be taxed under the provision of the Income Tax Act. You got my point or not? Yes. Now next case law is related to the Air India Limited 2023 Supreme Court judgment. Guys, if you remember, you know that there is a one Section 206AA. And 206AA says that suppose whenever you make the payment to any person and you require to deduct the TDS, and guys, suppose TDS rate is 5%, but suppose payee has not submitted the PAN number, then you have to deduct the TDS at the rate 20%. Like 5% or 20%, whichever is higher. If you remember, whenever you make the payment and suppose you have to deduct the TDS, but suppose payee has not submitted his PAN number. So when payee has not submitted his PAN number or Aadhaar number, then you have to deduct TDS at the rate 20%. Means whatever TDS rate or 20%, whichever is higher. So at 20% you have to deduct TDS. Now guys, what happened? Here in this particular case, Air India Limited made some payment to the non-resident. Now what happened? As per the DTAA between the country of that non-resident and India, suppose DTAA says that TDS required to be deducted only at the rate 7%. DTAA says that that income is taxable in hands of recipient at the rate 7%. So they deducted the TDS at the rate 7%, but guys, that person has not submitted the PAN number. So that person has not submitted the PAN number. So question is that when TDS is required to be deducted as per DTAA rate, then question is that still that Section 206AA is applicable or not? Section 206AA is still apply or not? That was the question. When TDS rate is as per the DTAA, then question is that still that Section 206AA is apply or not? Is TDS is required to be deducted at 20% when that non-resident has not submitted the PAN number or not? Now guys, here in the Air India case law, Supreme Court observed that Supreme Court first analyzed one section, Section 90 subsection 2 of the DTAA. Now if you remember the Section 90 subsection 2, that section says that like DTAA provision and Income Tax Act provision, whichever are more beneficial to assessee will be prevail. DTAA provision and your Income Tax Act provision, whichever is more beneficial to assessee, that will prevail. So here guys, more beneficial provision is suppose DTAA provision, so DTAA provision will prevail. Now question is that Income Tax Act says that Section 206AA. So is Section 206AA is still applicable when DTAA provision is applicable? Answer is no. So in this particular case law, Supreme Court decided the case, and Supreme Court says that whenever guys, if you deduct the TDS as per the DTAA rate and DTAA is apply, then DTAA apply, then Income Tax Act does not apply, and in Section 206AA, that section is not applicable, means there is no need to deduct the TDS as per Section 206AA. You got my point out? Even that payee has not furnished his PAN number or Aadhaar number. So what happened in this case law? Pay attention. Can the Section 206AA, which prescribe the higher rate of TDS in case of non-furnishing of PAN, override the DTAA that specify a lower rate of tax? High Court noted that Section 92 provide that the provision of DTAA would override the provision of the Act in cases where the DTAA are more beneficial to assessee. So when DTAA are more beneficial to assessee, then guys that DTAA provision is override your Income Tax Act provision. Even the charging section of section 4(5) of the act, which deal with the principle of ascertainment of the total income under the act, are also subordinate to the principle enriched in section 90 subsection 2. Guys, even that scope of total income and all, that is also override by the DTAA. Because for an example, suppose your Income Tax Act says that in India 5 income are taxable. Suppose A, B, C, D, E, 5 income are taxable. That is mentioned in Income Tax Act. But suppose DTAA says that only 3 income are taxable, then how many income will be taxable? Obviously 3 income are taxable, because DTAA provision override your normal Income Tax Act provision. So section 4 and 5 is also override by the DTAA provision. Thus, insofar as applicability of scope and rate of taxation with respect to the that is impugned payment made to the non-resident is concerned, no fault can be found with the rate of taxation involved by the assessee based on the DTAA, which prescribe for the beneficial rate of taxation. Section 195 of the TDS would apply only to the sum that are chargeable to tax under the act. Guys, section 195 of the TDS is applicable only when that sum is taxable as per the Income Tax Act, not as per the DTAA. The provision of DTAA along with section 459 1991 of the act are relevant while applying the provision of TDS. Therefore, the section 206AA cannot be understood to override charging section of 45 of the act. Accordingly, High Court upheld the ITAT ruling, which held that where the tax has been deducted on the strength of the beneficial provision of the DTAA, the provision of section 206AA cannot be invoked to insist on the tax deduction at the rate 20% having regard to overriding nature of the provision of section 90 subsection 2. The apex court, Supreme Court, upheld the decision of High Court resulting in the dismissal of SLP filed by the Revenue. Means department filed the SLP, but they have a special leave petition, but they have rejected that, and they says that if TDS is deducted as per the DTAA, then guys obviously like any provision of the Income Tax Act is not applicable. Even section 206AA is not applicable. You got my point or not? Yes. Now last case law, that is the Industrial Development Bank India Limited 2023 Supreme Court judgment. Now guys, if you remember, you know that we have discussed one section, that is the 263. 263 is the revision by the department. Means department can do the revision. Revision by the department means CIT, PCIT, CCIT, PCCIT. If they will call the file from the assessing officer, if assessing officer pass the assessment order, and they will call the file, and guys in file, if they get to know that there is a order is erroneous, and that order is harmful for the assessee, that is prejudicial to the interest of interest of department, not assessee, but for the department, then that the CIT or PCIT or CCIT or PCCIT is having the power that they can revise that order under section 263. And you know that what is the time limit to revise that order? That time limit is at 2 years from the end of the financial year in which order was subject to that revision was passed. So when order is passed from the end of that year, within 2 years, they may revise that order. Now guys, what happened? Try to understand. Suppose in case of one of the assessee, for the assessment year 1920, suppose assessment order passed under section 143(3) by AO, and that order is passed on 19 July 2022. Suppose on 19 July 2022, one order is passed for the assessment. Now, after some time, what happened? That assessing officer did the reassessment under section 147. And under section 147, there is a reassessment. And guys, suppose that reassessment reassessment happened on 15th of March 2024. Reassessment is on 15th of March 2024. Now guys, suppose CIT wants to do the revision under section 263 on 15th of Feb 2026. So on 15th Feb 2026, CIT want to do the revision under section 263. Now question is that on 15th Feb 2026, can he do so or not? Now guys, what happened? Here reassessment order is passed on 15 March 2024. So can I say that this year will be completed by 31st March 2024? So till 31st March 2026 he can do so. But as per the original order, that time limit is already expired. Now guys, what happened? Suppose if any matter which was considered in the reassessment order, and if CIT wants to do the revision of that order, then CIT can do so. But what happened in this case law? In this case law, there was one matter, that matter was not considered in the reassessment. Means ultimately that matter was belongs to the original assessment order. And on that original assessment order, here CIT wants to do the 263. So question is that, sir, this time limit of 2 years will be calculated from the date on which that original order was passed or reassessment order was passed. Right answer is that original order was passed. Original order was passed because that matter was belongs to the original order. Now in the reassessment order, that matter was not considered. So in this particular case, guys, that time limit will be applicable from here. Time limit is going to be applied here, and in this case here CIT cannot do the revision on this particular date if that matter is considered in the original order. But suppose matter was considered in the reassessment order, then can he do the revision? Answer is yes, then he can do the revision. So all people pay attention. What happened here? Industrial Development Bank of India Limited 2023 Supreme Court judgment. So guys, all 5 case law from Supreme Court 2023. Does the limitation period for exercising the power under section 263 reckon from the date of passing of the original assessment order rather than the date of the reassessment order for the issue covered under the original assessment but not covered in the reassessment proceeding? So here, as observed and held by the court in the earlier decision, once a order of assessment is reopened, the previous order of assessment will be held to be set aside. But guys, the whole proceeding would start afresh, but the same would not mean that even the subject matter of reassessment is distinct and different. The entire proceeding would be deemed to be reopened. It means that only in case where the issue before the CIT at the time of exercising the power under section 263 relates to the subject matter of the reassessment would be the limitation start from the date of the reassessment order. However, if the subject matter of reassessment is distinct and different, in that case the relevant date for the purpose of determining the period of limitation for exercising the power under section 263 would be the date of the original assessment order. Accordingly, the Supreme Court held that the issue before CIT while exercising the power under section 263 related back to the original assessment order which were not covered in the reassessment proceeding, and therefore the limitation would start from the original assessment order and not from the reassessment order. You got my point or not? Yes. Now next part. Amendment related to the notification and circular. So guys, this 5 was the case law. Now there are some amendment related to the very simple amendment. This is not more relevant for the examination. Now guys, first amendment is, if you remember the section 47 clause number 7AB, that is covered in the capital gain, and in capital gain topic there is a section 47, following transaction not regarded as transfer, capital gain is not applicable. There is a point number 7, and point number 7 says that suppose if any non-resident transfers certain asset in the recognized stock exchange located in the International Financial Service Center, then capital gain is not applicable. If you remember, then there was a list of some like instrument. One is the that is GDR, one is the bonds of Indian company, one is the that gold depository receipt. You know that, but that bullion depository receipt, as well as they mentioned that unit of the investment fund and all. So guys, if that rupee denominated bonds of the Indian company, so if that security is transferred by non-resident in the IFSC located recognized stock exchange and consideration received in the foreign currency, then capital gain is not applicable. Now they have included 3 more instruments. Now there is no need to remember this. Okay, first is unit of the investment trust, that is being REIT or InvIT. So basically REIT or InvIT is basically business trust, but now guys it's covered in the investment trust also. So under investment trust, if it is a REIT or InvIT unit and transfer by non-resident in the IFSC located recognized stock exchange, then capital gain is not applicable. Second is, if unit of any scheme And which scheme? A scheme of fund management entity launched under IFSC Authority Fund Management Regulation 2022 and unit of the exchange traded fund launch under the IFSC Authority Fund Management Regulation 2022. So guys, this name is given, just ignore that, not more relevant for examination. Okay, one more point, one more amendment. You know that section, there is a section 194A. 194A is related to the interest. On interest, TDS is required to be deducted if any interest is paid to any resident person, then an interest is more than 40,000 by the bank, then bank is required to, bank or cooperative bank or post office is required to deduct the TDS at the rate 10%. Now guys, here there is a Mahila Samman saving certificate, that is one government instrument issued by the post office and all. So on the Mahila Samman saving certificate, there is no need to deduct the TDS. On the Mahila Samman Saving Certificate of 2023 of the government, TDS is not applicable on this instrument. So if they ask a Mahila Samman Certificate, is TDS is applicable? Answer is no, TDS is not applicable. Okay, one more point. You know that section 194C, 194 is belongs to the dividend. Now, if any dividend is paid to any person, then obviously we have to deduct the TDS at the rate 10%. Now guys, in the IFSC, suppose there is a one company and that company is engaged in the business of leasing of the aircraft. Means that company, there is a one company in the IFSC and that company is engaged in the business of leasing of aircraft. Guys, Reliance is going to start this business in the IFSC. So in the IFSC, International Financial Service Center, there is a company and that company is engaged in the leasing of aircraft business. And guys, suppose that company paid dividend to the similar company, means that other company is also in the IFSC and engaged in the business of leasing of aircraft, and they paid dividend to the another company, then in hands of another company, that dividend is totally exempt under section 1034B. And this 1034B section I have covered in the international taxation. So in the international taxation, I have covered this section. This section says that when one company engaged in the shipping business, they're engaged in the leasing of aircraft, basically leasing of aircraft, that company gives dividend to the another company engaged in the leasing of aircraft in the IFSC, then in hands of that company, that dividend is totally exempt. And when that dividend is exempt, then obviously there is no need to deduct the TDS. So here there is a clarification that there is no need to deduct the TDS. So under section 194, dividend not applicable if dividend paid by unit of an IFSC primarily engaged in the business of leasing of an aircraft to a company being the unit of IFSC primarily engaged in the business of leasing of aircraft. So both are doing the same type of activity, and one company giving dividend to another company, that is exempt. So there is no need to deduct the TDS. So as the dividend is exempt in hands of the recipient under section 1034B. Now guys, there is a one section 194I. 194I is basically, 194I is related to rent. Now, if you remember, then I have mentioned in our compact, suppose in IFSC, International Financial Service Center, if there is any person and that person is let out or lease any aircraft, and you know that in IFSC located unit, there is no need to pay the tax for the 10 year. There is no need to pay the tax for the 10 years. So in IFSC, there is a one person. Suppose that person has lease out any aircraft. Then guys, whatever rent received by that person, that will be exempted for 10 year. 10 year, there is no need to pay the tax due to the deduction. And guys, there is a deduction under section 80LA. So here there is a one misprint. Instead of 194LA, it should be the 80LA. So under 80LA, that income is not taxable. So guys, here in the compact, if you remember, I have mentioned that if any person located in IFSC, they lease out any aircraft to any person, that person is paying the rent or lease rent, then there is no need to deduct the TDS if they are claiming the deduction under section 80LA. Now aircraft was covered there, but ship is not covered. Ship is not covered. So for the ship, they have again here issued one notification, and they are saying that suppose for an example, if any person located in IFSC, they let out the ship and this person is claiming the deduction under section 80LA for the 10 year, the person who pay the rent, that person is not required to deduct the TDS under section 194I. So here, 194I, not applicable if lease rent made by the lessee to the lessor, and that lessor is being a unit located in IFSC for the lease of ship for the 10 assessment year in which lessor claiming the deduction under section 80 LA. Now next part is related to the you know that guys, if you open any bank account other than basic saving account or FD account, then you have to quote your PAN number, means you have to apply the PAN number. PAN number is required when you open any bank account other than basic saving bank account and like FD account. And in case of the FD, you required to quote the PAN number if your single FD is more than 50,000, or in the aggregate in a year, if FD amount is more than 5 lakh, then you require to quote the PAN number. Now guys, suppose if there is any non-resident, there is basically any foreign company. So guys, if foreign company, suppose they started the bank account in the IFSC, they started, means foreign company opened the bank account in the IFSC, or suppose they made the FD in the IFSC located banking unit, then is they also required to apply for the PAN? Answer is no. Here in this particular here in this particular point, they mention that whenever any foreign company, they have opened the bank account in the IFSC, or they have opened the FD account and all, and guys, their income is not taxable in India. Suppose their income is not taxable in India, then if they don't have the PAN, it's okay. They just need to fill one form, that is form number 60. So they will file one form number 60. So what this point says, try to understand. Foreign company who does not have any income chargeable to tax in India and does not have a PAN and enter into the following transaction in the IFSC banking unit has to make the declaration in form number 60, either opening a bank account or FD with the bank or a cooperative bank or post office or Nidhi or NBFC. Then now guys, one more point, if you remember, then you know that we have discussed that who required to apply for the PAN. So if you remember section 139, and in 139A there is a point number 6, and point number 6 in the compact, if you remember, there is a mention that suppose if you deposit 20 lakh rupees or more in any account, or if you withdraw 20 lakh rupees or more from any account, or suppose if you open the cash credit account, then guys, you have to apply for the PAN. You have to apply for the PAN. Now question is that, sir, suppose for an example, if there is any non-resident or foreign company, and in the IFSC located banking unit, they are depositing money, or they are withdrawing, or they open the cash credit account. So question is that, is they also required to apply for PAN? Answer is no. If they don't have any income that is taxable in India, then there is no need to apply for the PAN number. So here, if a person entering into the specified transaction, that is cash deposit or withdrawal 20 lakh or more, or opening the cash credit account with the bank or cooperative bank, that is point number 6 of compact, section 139A, required to apply for PAN. In case of non-resident or foreign company entering into this transaction in IFSC banking unit, and such non-resident foreign company not having any income in India, not required to apply for the PAN. Now next point, that is point number 7. If you remember section 142(2)A, that is the special audit. A special audit, if you remember, that we have discussed in the assessment procedure, when assessing officer get to know that when he was checking your books and he checked that your books is very complex, and guys, there may be some duplication of entry, there may be he is having the doubt over your books of accounts and all, and he feel that there will be a special audit or there will be an inventory valuation, then it will be beneficial for the department, then he can give you the direction for the special audit and all. Now guys, special audit and inventory valuation, who will do the special audit? A special audit will be done by the chartered accountant, and inventory valuation will be done by the CMA, that is cost and management account. Now, but who will appoint that? That a person will be appointed by the CCIT or PCCIT or CIT or PCIT. Who will pay the remuneration to the auditor or inventory valuer? Right answer is remuneration will be paid by the central government. Now question is that, sir, what will be the remuneration of chartered accountant or CMA or any article or any audit assistant? That person will help in the special audit. So what will be the minimum up to minimum remuneration or maximum remuneration? So here guys, one limit is given. Try to understand. So the expenses of audit or inventory valuation, including the remuneration of the accountant or cost accountant or qualified assistant or semi-qualified or any other assistant who may be engaged by such accountant or cost accountant, should not be less than 3750 and not more than 7500 for every hour of the period as specified by the AU. So guys, here for a chartered accountant as well as the cost accountant as well as their semi-qualified staff, other assistant who is engaged by the CA and CMA, their minimum remuneration will be 3750 and maximum will be 7500 per hour, and that hour will be decided by the assessing officer. Now last point number 8. Guys, in the point number 8, there are certain correction in your compiler. So if you are having the May or November 2024 compiler, then guys, in the compiler actually there is a one small like error from my side, and that error is in the question number 30, 31 and 32 of the NR taxation topic, non-resident taxation topic. You know that now that royalty under section 115A, that royalty and FTS is taxable at the rate 20%. But till last year it was a 10%. Till last year it was 10%. Now it is a 20%. But what happened in the question number 30, 31, 32? Like I just forget to change the rate, and in all three questions I have considered the 10%. Please make it change and just consider the 20% instead of the 10%. So in the NR taxation topic, royalty FTS taxable at the rate 10%, but as per the amendment it should be taxable at 20%. And guys, in the question number, like please consider 20% instead of 10%, and in question number 30, DTAA rate can be considered as 22% instead of 12%. I think they're given as 12%, just consider 22%, and accordingly your answer will be changed. Question number 30 answer will be 17,84,550. Question number 31 part 2 answer will be the 99,29,090, and question number 32 your answer will be the 12,11,600. So just you have to change in your compiler if you are having the compiler of the May November 2024 exam. Done. So this is the completion of the case law as well as the certain clarification for your examination. Now we are going to start with the latest development in the international taxation. So in the latest development of international taxation, our government, not our government basically, like OECD and all, they have introduced one new concept that is called BEPS 2.0. BEPS 2.0, that is base erosion and profit shifting 2.0. Now guys, 2.0, if you remember the BEPS, then you know that in the BEPS there are 15 action plan. Plan number 1 is related to the digital economy, and due to that equalization levy was introduced and all, that was BEPS action plan number 1. As well as you know that after that there was a BEPS section plan number 4 was related to the transfer pricing theme capitalization. So that all was BEPS section plan. There were 15 plan. Now guys, after BEPS 1.0, that BEPS 1 also, there are various company, they used to evade the tax. They used to shift the tax to the country where tax rate is very less, or you can say that tax haven countries, and overall their tax burden is very less. Now there are various company, they are actually doing the business digitally. That is, example is Facebook, Google, as well as all other Twitter and all. So they are earning the income from various countries in the world, but they are not paying the tax in those countries. So just mitigate that defect, they have introduced one concept is called BEPS 2.0. And guys, this BEPS 2.0 is a landmark agreement. Like 137 countries made this agreement. And this agreement is made on the 8th of October 2021. And guys, 137 countries agree to follow the BEPS 2.0. And this BEPS 2.0 is just to remove the defect where that company doing the digital business, they are not paying the taxes and all in the country where they are generating the income. So just to remove that defect, they have introduced the BEPS 2.0. Now what is the BEPS 2.0? We will discuss. All people pay attention. So here, introduction of the two pillar solution in BEPS 2.0, they have mentioned two pillar. Now pillar 1 is related to the profit allocation and nexus, and pillar number 2 is related to the minimum taxation, and they mention that multinational group has to pay at least 15% tax in all world, means whole world they have to pay the minimum tax that is given in the pillar number 2. We'll discuss pillar number 2 in the later part. First we will discuss about the pillar number 1. Now, 137 countries and the jurisdiction have joined the landmark agreement on the two-pillar solution to address the tax challenges arising from the digitalization of the economy on the 8th October 2021. So guys, this the BEPS 2.0 is having the two-pillar solution, and this two-pillar solution they have introduced to address the tax challenges arising from the digitalization of the economy on the 8th October 2021. Now, what is the pillar number 1? All people pay attention. Pillar number 1 is very simple pillar. Now, what pillar number 1 says that? Pillar number 1 says that, for an example, guys, there is a one multinational group. So, for an example, there is a multinational group and that MNC name is a Unilever Limited. Now, guys, Unilever Limited is earning income. That income is, suppose that income is basically more than 10%, means their profit margin, that is profit before tax divided by total revenue. So profit before tax divided by total revenue, suppose their profit percentage is more than 10%. For an example, suppose their profit percentage is 22%. So guys, they are saying that 10% profit is basically routine profit. That is the routine profit, no issue. But guys, whatever profit in excess of the 10%, so here in this example, your excess profit is at 12%. Now guys, out of the 12%, 25% of the 12%. So 25% of 12% comes to the 3%. 3% profit we will allocate to the countries from which you are getting the income, and you are not paying the taxes in that country due to this pillar number 1, due to that BEPS 2.0 pillar number 1. This 3% profit we will allocate to the country from which you are earning the income. And there is a nexus test, and after nexus test and after revenue sourcing rule, we will like distribute or allocate that profit to that country, and that country can charge the taxes. Now, for an example, guys, I can take an example. There is a one group, name is a Unilever. Now, Unilever total profit, MNC, that multinational company, their total profit before tax divided by revenue, that comes to the 22%. So, out of 22%, 10% is your routine profit, no issue. Now, guys, in excess of the 10%, so remaining is your 12%, and out of this 12%, 25% profit, means out of this 12%, 25% of 12%, that comes to the 3%. This 3% profit will be allocated to the countries from where you are getting your revenue. Means if nexus test is fulfilled, then we will allocate that profit to those countries, and that countries can collect the taxes on that profit. So this is basically your BEPS 2.0 plan and pillar number 1. And pillar number 1 is basically profit allocation and nexus. Even your physical presence is not in those countries, then also your profit will be allocated to those countries on the basis of the nexus rule. So pay attention. Pillar number 1 says that pillar 1 is a significant departure from the standard international tax rule of the last 100 years and move away from the idea that taxation largely requires a physical presence in the country before that country has a right to tax. So guys, from last 100 years, what we are doing, like country can charge the tax only when you are having the physical presence in that country. But guys, now due to this pillar number 1, even there is no physical presence, then also that country can get the right to tax your income. So here, pillar 1 apply to the multinational group MNC that have the more than 20 billion euros. More than 20 billion euros of the global turnover, and their profitability is more than 10%, measured as profit before tax divided by the revenue. So guys, here this pillar number 1 concept is applicable only to the MNC or multinational company which is having the global turnover of 20 billion euros. So guys, 1 billion is basically 100 crore. 20 billion is 2000 crore euros, and 2000 crore euros multiply by, if you multiply by the 90 rupees is 1 euro rate, then you will get in the Indian currency. So if their global turnover is more than that, then only this pillar 1 is applicable, and their profitability is more than the 10%, then this pillar is applicable. Now, foreign scope group 25% of profit above the 10% profit margin referred to as the amount A will be subject to the reallocation to the market jurisdiction based on the formal reapproach. So what will happen? Just here try to understand, there is a amount A. So amount A, how this amount A will be allocated? So try to understand. So guys, here first is a routine profit. So your routine profit is a profitability threshold is 10% of profit before tax divided by turnover. So 10% profit is your routine profit, no issue. But guys, whatever your residual profit, out of this residual profit, your 25% profit allocated to the market jurisdiction, and this is known as the amount A. Market jurisdiction means, I can take an example. Suppose Unilever is basically, or for an example, we can take an example of the Facebook. Now Facebook is based in the USA, that is the USA company. Now from whole world, if their turnover is more than the 20 billion euros and their profit percentage is more than 10%, then what will happen? You know that 10% profit is, but profit before tax divided by revenue, profit before tax divided by the revenue. So that is more than 10%. So 10% is routine profit. Now in excess of 10%, whatever the profit, out of that profit, 25% profit will be allocated to the countries, from where they are getting their revenue, means where they are having the nexus test is fulfilled, then this profit will be allocated to those countries. For an example, they are getting the income from India, and in India they are not paying the taxes. Then guys, their 10% profit is routine profit, above 10%, and in above, out of that above, 25% profit will be allocated to those countries on the nexus test basis. So you understanding the what they are doing. So they are saying that suppose if there is any multinational companies, and multinational companies, their total turnover of the global turnover is more than the 20 billion euros and their profit is more than 10%. 10% is a routine profit. Guys, in excess of 10%, whatever excess profit, out of excess, 25% profit will be allocated to the other countries. Even in those countries, they don't have any physical presence. But guys, from those countries, they are getting the income. Suppose they are sourcing the revenue from those countries, then those countries will get the right to tax that profit. You got my point or not? Yes. So here you understand this part. 10% is routine profit, in excess of 10% means that is called your residual profit, and out of this residual profit, 25% profit will be allocated to the market jurisdiction. But how this allocation will be made? Try to understand. So allocation of amount A is majorly based on the following two factors. One is the nexus test and one is the revenue sourcing rule. Now this profit, that excess profit, that amount A will be given to which countries, guys? So that will be depend on the nexus test. Now what nexus test says, try to understand. Nexus rule applies solely to determine whether the jurisdiction qualified for the profit allocation under the amount A or not. Means which country will get that profit allocation, and which country will charge the tax on that profit allocated. So here, this rule will not alter the nexus for any other tax or non-tax purpose. Amount A is allocated to the market jurisdiction only if the nexus exists, and to determine whether the M&E in scope amount A satisfied the nexus test for amount A is in jurisdiction, it will have to apply the revenue sourcing rules to identify the jurisdiction in which revenue arise for the purpose of amount A. Now guys, this profit, whatever that excess profit, out of excess 10% is routine, and now in excess of 10%, and in out of that excess 25% will be allocated to the other countries. But guys, this will be allocated only to those countries from which this M&E is getting market revenue threshold, and their market revenue from that country is greater than or equal to 1 million euros. When that country's GDP is the more than 40 billion euros. That country GDP is more than 14 billion euros. And guys, suppose if that country GDP is equal to or less than 40 billion euros, then guys, from that country, they are getting the revenue that is 2,50,000 euros. Only to those countries they will allocate the tax, allocate the income. So guys, in simple word, try to understand. Suppose for an example, there is a Facebook. Now suppose Facebook, obviously for a year, Facebook global turnover is more than 20 billion euros. Now Facebook profit is suppose 22%. So what will happen? So out of 22%, 10% is routine profit. Now in excess of 10% is 12%. So out of that 12%, 25% comes to 3%. 3% profit will be allocated to the different countries. Even in those countries, they don't have the like permanent establishment, or they don't have the physical presence. Then also that profit will be allocated to those countries. And guys, this profit will be allocated to those countries. So which country will qualify for this allocation? So here condition is satisfied. And what is the condition? Suppose Facebook is getting the revenue from that country, and that revenue is more than 1 million euros. If that country's GDP is more than equal to 40 billion euros, and if that country GDP is 40 billion euros or less, then revenue from that country is a 2,50,000 euro, 2,50,000 euro, then that country will get right to tax on that excess profit. You got my point or not? Yes. It transferred taxing right over residual profit to the jurisdiction with business activity regardless of the physical presence. Revenue sourcing rule means revenue will be sourced to the end market jurisdiction where goods or services are used or consumed. So where basically like Facebook goods or services used in the India. So India will get the right to tax on that excess profit. Excess profit means not more than 10%, like more than 10%, but in excess of 10%, and out of that excess only 25%. That will be treated as your allocated profit. Now, what will be the process? Determine the revenue category, identify various transactions in each category. Using revenue based allocation key, apply sourcing rules to the identify the market for revenue in category for transaction by transaction basis, and in absence of the specific allocation key, use the appropriate allocation key to the source revenue to the market jurisdiction. Now guys, this is the very new concept. Still it is in the developing phase. Now what you have to remember from the pillar number 1. Pillar number 1 is basically your profit allocation and nexus. You can remember that pillar number 1 of the BEPS 2.0 is a profit allocation and nexus. Now what this pillar says, when this pillar will apply? This pillar will apply to a multinational group when their global turnover is more than 20 billion euros, billion euros, and guys their profit is more than 10%. If that condition is, both condition is satisfied, and suppose their profit is more than 10%, then 10% is routine profit, and profit before tax divided by revenue, profit before tax divided by revenue, if that is more than 10%, 10% is routine profit. Now in excess of 10%, whatever excess profit, out of that excess profit, 25% profit will be allocated to the different countries. But which country will get that profit? You know that only if nexus test is fulfilled, and your nexus test is fulfilled when market revenue from those country, if that country GDP is more than equal to 40 billion euros, and this company is getting the revenue from that country is more than equal to 1 million euros, and suppose if that country GDP is 40 billion euros or less, and this company is getting revenue from that country is a 2,50,000 euros, then guys that country will get the right to taxing that particular excess profit. You got my point or not? Yes. Now guys, so just you have to remember little bit. Now from this particular topic you can get the MCQs in your examination. Now which type of MCQ you will get? You know that I have shared certain MCQ, yeah. So this all are MCQ I have shared. This MCQ is from the ICI only. So ICI has issued the MCQ. They have given on their board of study portal. So here guys, in this topic they have given 5 MCQs. So here this all 5 are MCQs. Okay, so first check the MCQ number 2. Now what MCQ number 2 says that? MCQ number 2 says that in scope companies are MNC with, means when this particular pillar 1 is applicable, when global turnover is more than 20 billion euros and profitability is more than 10%, but profit before tax divided by revenue. So can I say that C will be the correct answer here? Here C is your correct answer. Here C is your correct answer. So that is the question number 2. Now question number 5. Now question number 5 says that amount A. Amount A means whatever your profit, so 10% profit in excess of 10%, and out of that excess 25% will be the amount A that will be allocated to the various countries. So here guys, 10% of residual profit that will be allocated to market jurisdiction, or 15% of residual profit, or 20%, or 25%? Guys, right answer is 25% of residual profit. So whatever 25% of residual profit, that will be allocated to the like market jurisdiction from where they are getting the revenue. You got my point or not? Yes. So for the question number 5, your answer is D. So D is the right answer. Done. Now guys, we will discuss about the pillar number 2. And guys, this is all about, we have discussed now that excess profit, that is like amount A in this pillar 1. Now amount B, simplify the existing transfer pricing rules for all taxpayer. So in amount B, they mention about the transfer pricing rules and they have simplified the transfer pricing rule. No need to remember. Now we are going to start with the pillar 2. And guys, pillar 2 is your global minimum taxation. And in pillar 2, they have introduced two type of rule. One is the GloBE rule, or I can say that the global anti-base erosion rules. And one is your STTR. STTR means subject to tax rule. Now, what is the GloBE rule and what is the STTR rule? I am going to explain you. Try to understand. GloBE rule says that whenever any multinational group, and that multinational group revenue is at least 750 million euros. Here rule number 2, that pillar 2 is applicable only to the multinational group when their revenue is a 750 million euros. And guys, that pillar 1 was applicable when their revenue, that turnover was more than 20 billion euros. But here pillar 2 is applicable only when their group revenue is like 750 million euros. Now guys, what this rule says, that there are two type of rule. One is the GloBE rule and one is the STTR. STTR means subject to tax rule. Now GloBE rule says that if there is a multinational company now, then in every country, in every jurisdiction, they have to pay the minimum tax of 15%. They have to pay the minimum tax of 15%. Suppose if they are paying the lower tax, means suppose they are paying the 10% tax, then that country has the right to charge the top-up tax, that is called your 5% will be top-up tax. Because minimum tax is 15%. So for an example, I can take one example. There is a one multinational group and the multinational group name is a Unilever. Now Unilever is paying suppose 5% tax in Dubai. In Dubai, tax rate is 5%. They are paying 5% tax in Dubai. That is less than your effective tax rate. Like 5% is effective tax rate. That is less than 15%. So here 10% will be the top-up tax that can be charged by the Dubai government. So Dubai government may charge the 10% top-up tax. So that is called your GloBE rules. Now guys, there is a one more rule that is called STTR. STTR is a subject to tax rule. Now what is the subject to tax rule? The subject to tax rule says that whenever any associate enterprise made the payment, means one associate enterprise made the payment to the another associate enterprise, then guys, there should be a minimum STTR rate is a 9%. Suppose for an example, one company is located in India and one company is located in UK. Example is Unilever UK, and in India Hindustan Unilever. Hindustan Unilever made the payment to the UK Unilever. Then guys, when there is an intercorporate transaction, or you can say that with the associate enterprise transaction, then minimum that TDS rate, or you can say that tax rate, should be the 9%. This is called your STTR. So here in the second pillar, you will understand two type of rule. One is the GloBE rule, that is global anti-base erosion rules, and one is the STTR, that is subject to tax rules. And guys, GloBE rule says that in the every jurisdiction, that company MNC has to pay the tax at the rate 15%, means minimum tax is a 15%. And STTR rule says that whenever payment is made between the associate enterprise and all, then that should be subject to at least 9% minimum rate. That is called your STTR. Now what this point says, try to understand. Pillar 2 rules subject to thousands of multinational group around the world to a global minimum tax of the 15%, or you can say that GloBE rule. Critically, every jurisdiction in which the group has operational will need to be looked at separately to see if its effective tax rates falls under 15% or not. If so, then top-up tax will be need to be calculated and paid. Additionally, specified payment made to the related party, associate enterprise, and the taxes below 9% may be subject to the new withholding tax that is called STTR. Pillar 2 will apply to the multinational group only when the revenue is at least 750 million euros. Now guys, subject to tax rule or STTR. Now what is the STTR? Now STTR works in priority of the GloBE rules. STTR is a treaty-based rule that enable developing country, that is source jurisdiction, to tax certain intercompany payment at source, which are subject to the nominal corporate income tax at rates below the STTR minimum rate is 9%. Applicability when this STTR is applicable. So here, STTR applicable only to covered payment. Covered payment means like you can say that the like passive income. On the passive payments, this will be applicable by an entity of the developing country made to the group entity in the another country, or you can say that connected person. And guys, it apply only if the total sum of the covered income arising in source country exceed the threshold of the 250,000 euros or 1 million per year, depending on the GDP of that country. So guys, this STTR will apply only if from that country they are getting the revenue that is more than 250,000 euro or 1 million euro, depends on the GDP of that particular country. Now what is the meaning of covered payment? So here STTR is applicable in case of covered payment. What are the covered payment? So covered payment constitute the interest or royalty or payment for distribution of right for product or service, insurance or reinsurance premiums, payment of the guarantee or financing fees, renting payment for industrial, commercial or scientific equipment, payment for services, etc., etc. Now, connected person are defined to have legal, direct or indirect ownership of more than 50% of the interest or de facto control relationship. Just remember associate enterprise. Okay, that is called your like connected person. Now, you can understand the STTR. What is the STTR? I can take an example. Suppose guys, there are two countries. One is the country A and one is the country B. Now, country A is a developing country. Example, suppose country A is India. India is developing country. And country B is suppose Japan. Japan is your like developed country. Now what happened? In India, there is a one company, name is a company A, and in Japan there is a company B, and both are connected person, both are associate enterprise. Now what happened? Suppose this Japan company B, they have given one license to use the trademark to the Indian company. Now they are paying the royalty. Like Indian company A is paying the royalty to the company B in the Japan. Now guys, suppose Japan is charging the nominal tax rate is only 1%. Now Japan charging the nominal tax rate of only 1%. And guys, as per the tax law, suppose India is deducting the TDS only at the rate 5%. India deducting the TDS at the rate 5%. So in Japan, the royalty is taxable at the rate 1%, and in India suppose they deducting the TDS at the rate 5%. Now here STTR says that minimum tax should be 9%. So it means suppose 1% here in the country that is Japan and 5% TDS is deducted on that payment in India, so total is the 6%, so it is below the 9%, so 3% will be the STTR. Subject to tax rule says that here 3% more STTR will be deducted by the company A in India. So Indian company will deduct the more TDS, or in simple word I can say that they will deduct the 3% more TDS. So it will be treated as the STTR. You got my point or not? So here pay attention. So country A and country B is incorporated in STTR provision and their tax treaty. STTR rate is 9%. Now guys, nominal tax rate applied in the resident jurisdiction, country B is charging tax only 1%. Now guys, taxpayer jurisdiction, that is country A, retain the 5% withholding tax, that is the TDS. So guys, here total is 6%. Now STTR specified rate, country A to tax under STTR at the rate 3%. So here India will get the right to charge 3% taxes, means additionally they will deduct the 3% more TDS on that payment. You got my point or not? Yes. So that is called your STTR rule. Now guys, we are going to start with one very interesting point. That is in pillar 2 consists of the following rules, that is GloBE rule. Now guys, in the GloBE rule what happened? I can take one example and from example try to understand how. Suppose for an example, there is a country X Instead of country X, I am just taking the example of the UK. Now guys, in UK, there is a one parent entity. UPE means ultimate parent entity. In UK, there is a one company that is UUL, that is UK Unilever Limited. Unilever Limited is from UK. Now guys, this UK is having one company in India also. So suppose in India, they are having one company is a HUL. In Pakistan also, they are having one company in the name of the PUL, Pakistan Unilever Limited. And guys, they are having one company in UAE also, in Dubai also. And in Dubai, that company is known as the Dubai Unilever Limited. So Dubai Unilever Limited, DUL, Dubai Unilever Limited, they are having one company in the Dubai also. So guys, try to understand, there is a one Unilever group. Unilever group parent entity is located in UK, that is known as the UUL. Now in India, they are having the HUL. In Pakistan, they are having the PUL. In Dubai, UAE, they are having the DUL. Now guys, you know that from this pillar number 2 says that as per Globee rule, in every jurisdiction, multinational company, multinational group should pay at least 15% tax. That is minimum tax is 15%. Means they should pay the minimum 15% tax in every jurisdiction. Now guys, question is that, sir, when you are saying 15% tax in every jurisdiction, so under that jurisdiction or under that country, suppose they are having the 2-3 company of same group in that country, then question is that is profit as well as the, suppose there is a loss and revenue, means profit, whatever the tax they are paying basically. So tax and profit, question is that we will do the blending or not. Means for an example, I can take one example. Suppose Unilever group of the UK, and Unilever is having 2 companies in India. One is the Hindustan Unilever. Suppose they are having one more company in India. So when they are having the 2-3, same group is having the 2-3 company in India, and in India their tax should be at least 15%. So question is that to check that 15% effective tax rate in India, question is that they are having the 3 company in India. So all 3 company that profit, because tax divided by profit we have to check, tax divided by profit we have to check. So tax divided by income, you can say that. So whatever the tax and income, question is that we will do the blending or not, means we will aggregate that profit and loss or not. Right answer is yes. So jurisdictional blending is allowed. Jurisdictional blending you will do, and after that you will check that is effective tax rate is below 15% or like 15% or more. If it is a 15% or more, there is no issue. But if it is a below 15%, then that country will charge the top-up tax. You got my point or not? Yes. Now try to understand this point. All people pay attention. What happened? Now only last 5 minutes. There is a one company in UK, name is a Unilever Limited, UUL. Now guys, what happened? They are having one company in the UAE, Dubai, that is DUL, and you know that Dubai is a low tax jurisdiction country. Dubai is a low tax jurisdiction country. Now guys, suppose in Dubai tax rate is 5% only. In Dubai tax rate is 5%. But now as per the pillar 2, minimum tax rate is 15%. So can I say that they will ask Dubai to charge the 10%, they will ask Dubai to charge the 10% additional tax, that is known as the top-up tax. And this top-up tax will be known as the QDMTT. This top-up tax, if it is charged by Dubai only, then that 10% tax, whatever they are charging, that will be known as the QDMTT. Now, what is the QDMTT full form? QDMTT full form is the Qualified Domestic Minimum Top-up Tax. Qualified Domestic Minimum Top-up Tax, because they are charging 5%, but minimum tax should be the 15%. So they are charging only 5%. So that domestic tax will be 10%. That 10% will be known as the QDMTT, that is Qualified Domestic Minimum Tax. QDMT also you can say. So here try to understand. The QDMTT imposed a jurisdiction top-up tax on the constituent entity located in low tax jurisdiction. It allowed to the low tax jurisdiction, that is Dubai, to collect the top-up tax computed in accordance with the Globee rule. Now, QDMT provides the right to the low tax jurisdiction to collect the jurisdictional top-up tax by way of the introduction of the QDMT in its domestic tax law, and this would preserve a jurisdictional primary right to taxation over its own income. So basically here Dubai will charge the 10% more tax because 5% they are charging, but now as per the pillar 2, minimum tax should, as per Globee rule, minimum tax should be the 15%. So they are charging 5% tax, so 10% will be the top-up tax that is charged by the Dubai only. That will be known as the QDMT. That is qualified domestic minimum top-up tax. But guys, suppose for an example, Dubai is not charging the top-up tax. Dubai is not charging the top-up tax. Dubai is charged only 5% tax. There is no Globee rule related law in Dubai. So Dubai is not charging that 10% tax. Then guys, this rule says that here UK will charge that 10% tax. Means whatever income earned by this Unilever from Dubai, so on that amount guys, UK will charge that 10% tax, and this 10% tax charged by the UK, that will be known as the IIR. IIR means income inclusion rule. Income inclusion rule. So here IRR imposed a top-up tax on the parent entity in respect of the constituent entity located in low tax jurisdiction. A constituent entity, that is the ultimate parent entity of M&E Group located in Globee implementing jurisdiction, that own directly or indirectly the ownership interest in the low tax constituent entity at any time during the fiscal year, shall pay the tax in an amount equal to its allocated share of the top-up tax to that low tax jurisdiction entity for the fiscal year. So in simple word guys, it's very simple. There are two types. One is that is QDMT, and now we are discussing about IRR. Now what is the QDMT? QDMT is, suppose Dubai tax rate is only 5%, minimum tax should be 15%. So Dubai charge the excess 10%, it will be known as the QDMT. But suppose Dubai is not charging the QDMT, then guys, UK will charge the IIR. UK will charge the IRR, that is income inclusion rule. Now guys, suppose like Dubai is not charging the QDMT, UAE, that UK is not charging the IIR, then guys, they have given the right to India and Pakistan, and India and Pakistan, they will charge the 10% taxes on whatever income, income of the Dubai company. On that income, like India and Pakistan will charge the tax. That is known as the UTPR. That is known as the UTPR. UTPR means under tax payment rule. So this is very difficult part, UTPR, because Dubai is not charging the top-up tax, as well as that UK parent entity, that country is also not charging. In that case, that suppose they are having the constituent entity in the other country, so other country will get the right to charge the tax, that 10% tax. So here UTPR impose deduction or require an equivalent adjustment to extent of low tax income of the constituent entity is not subject to tax under IRR. UTPR is triggered where the UP, that ultimate parent entity jurisdiction, does not implement the IIR or does not adopt the Globee rule. Thus UTPR serve a backstop to IIR. UTPR transfer the levy of top-up tax to the other constituent entity of M&E Group located in the jurisdiction where the Globee rules are implemented. So suppose in India, Pakistan, Globee rule is applicable. In that particular case, India, Pakistan can charge that much taxes. You got my point or not? Yes. So this you have to remember. Now guys, as per the pillar number 2, that minimum tax rate on every constituent entity, every country, they have to pay minimum 15%. Suppose in any low tax jurisdiction country, it is below 15%, then there are 3 ways to collect the taxes. One is the QDMT, means that country can charge the top-up tax. If that country is not charging, then parent country can charge the top-up tax. If parent country is also not charging, then other constituent entity is having in different country where this Globee rule is applicable, then that country will charge the top-up tax. You got my point or not? Yes. Now guys, how you will calculate the effective tax rate? Because if your effective tax rate is below 15%, now effective tax rate is below 15%, then only this Globee rule is applicable. So here effective tax rate means the Globee rule will operate to impose the top-up tax using the ETR test, that is calculated on the jurisdictional basis. If the jurisdictional ETR is below the 15% minimum rate, the jurisdiction is treated as a low tax jurisdiction, and the constituent entity are treated as a low tax constituent entity. Now ETR means here total of the adjusted. Now total of the adjusted covered taxes of each constituent entity located in jurisdiction. So guys, like in Dubai, what is the total amount of taxes divided by net global income of that jurisdiction? What is the income from Dubai? So what is tax paid in Dubai and what is the income from Dubai? So here you will get the ETR, that is effective tax rate. Now net global income, so global income of all constituent entity minus global losses of all constituent entity. So guys, in Dubai, suppose there are 3-4 entity, so just take the income and losses and you have to take the net global income and net taxes. So taxes divided by global income. So here you will check the net global means that constituent entity income, na yaar, Dubai income. So in simple word, whatever, like suppose there are 4 companies in the Dubai. So in that case, 4 companies, what tax they paid, just do the aggregate and divide by the like what what is the total income of that 4 company, just divide that and you have to calculate the effective tax rate. If effective tax rate is below 15%, then only global rule is applicable. Now guys, you can do the jurisdictional blending. Answer is yes, you can do the jurisdictional blending. I already explained. The ETR computation is determined on the jurisdictional blending basis. Jurisdictional blending allow all the profit, losses, taxes of the constituent entity of the M&E group located in same jurisdiction to be blended for the purpose of effective tax calculation. For the purpose of determining the applicability of global rule, guys, global rule is applicable or not? For that purpose we have to check the global revenue. But guys, here for the effective tax rate calculation, we will calculate on the jurisdictional basis, means for all countries we will check separately. Now substance based income exclusion, you can like ignore this point, not like you will not not more important for your examination. That is substance based income exclusion, just ignore that. Okay, now what is the top up tax? Top up tax is basically, in simple but top up tax is your minimum tax should be the 15%. Suppose for an example your tax rate is below 15%, then like obviously that remaining is your top up tax. So on excess profit you have to apply the top up tax percentage. Top up tax percentage means minimum rate is a 15% minus effective tax rate suppose 5%, so 10% is your top up tax. Now one more point guys, this is top up tax is not applicable, this top up tax is not applicable on any in the any like a country from which their revenue from that jurisdiction is less than 10 million and average global income or loss of such jurisdiction is less than 1 million. So in simple word guys, for an example, Unilever is having one presence in Nepal also, but in Nepal they are getting very less revenue. From Nepal they are getting very less revenue. So guys, from Nepal, suppose their revenue is less than 10 million euros and from Nepal their profit or loss is less than 1 million euros, then guys there is no need to check that, there is no top up tax and all, that is not applicable in the Nepal. So in simple word, suppose any multinational companies from any country, their revenue is less than 10 million euros and their profit is less than 1 million euros, in that particular case like that concept is not applicable. There is no need to check the minimum tax and top up tax rate and all, that is not applicable. Okay, so done. So this is all about this question, this topic. Now guys, from this topic you can get only MCQ. I feel you will get the 1 or 2 marks MCQs. Obviously you will not get the practical question or any big theory question, only you will get the MCQs. And guys, here ICAI has given the 5 MCQs. So 2 MCQs we already discussed. Let's discuss the first MCQ. Now first MCQ is a pillar 2 consists of, guys, pillar 2 of the BEPS 2.0. pillar 2 is about the global rule and STTR. So here that pillar 2 is consist of the global rule and STTR, that is the part A, that is option A is the correct answer in the question number 1. Question number 2 we already did. Now minimum rate tax prescribed in the pillar 2. So in pillar 2, can I say that they have prescribed about the STTR and global rule? So as per the global rule, their minimum tax should be the 15% and STTR says that 9%. So 15% and 9%. So I think D is a correct answer of question number 3. Question number 3, yeah, D is a correct answer. Now question number 4. Which rule impose a top-up tax on the parent entity in respect of constituent entity located in the low tax jurisdiction? So suppose Unilever Group, one company is located in Dubai. So Dubai, if Dubai charges the extra tax, then it will be known as the qualified domestic minimum tax, that is QDMT. Suppose UK charge the tax, then it will be known as the IIR, and if India Pakistan charge the tax, then it will be known as the UTPR. So here guys, when parent entity country will charge the tax, that is known as the IIR. You got my point or not? Yes. So guys, this is the completion of your topic. So I think I took approx 1 hour and 23 minutes, and within 1 hour 23 minutes we have discussed that 5 case laws, as well as we have discussed the latest development in the international taxation. I feel you will get the 1 or 2 MCQs from this topic. So just remember this 5 MCQs as well as whatever we have discussed in the class. Just remember that. Okay. So thanks a lot, people. That's enough for today from my side. See you in revision lecture. Bye.